Cryptic Humility.
Okay, let's get to it. Welcome back, guys, to Cryptic Humility. My name is Vanessa Hurley. I am your host and guide. Today we are on episode 5. It's crazy. I feel like the weeks are going by so fast now that I've been recording on the weekend. It just shows you how fast time really flies, and to take appreciation towards every single moment. But today we're going to be talking about Ethereum. If you have not been following the podcast up until this point and you're a beginner, I would encourage you to watch the first couple episodes first, because in this podcast episode, we're going to be going into a lot of things that I already kind of touched upon, and we'll be going into them more in detail. I will do a recap on some of the topics in this episode, but if you haven't listened, please go and listen. And if you have been here, you know that we do Q&As. We have no Q&As. And in the last podcast episode, I was talking to you guys about TikTok, which TikTok is back on, but now I'm in like huge debates about where I'm going to be promoting my content, which I don't know if we're still going to continue on TikTok. Everything is just so up in the air right now. And you know, when you promote on TikTok, you pay to get your video out there. So I have to weigh into the costs and if TikTok is actually going to stay around before I invest any more money. So you can find us on X and YouTube, as I said previously. We're still on TikTok, but I don't really know how it's going to go right now. Anyways, let's get into it because we have a lot to talk about and I don't want to ramble on. But so today we're going to be talking about Ethereum. But first, before we talk about Ethereum, we need to understand Bitcoin and how that differs from Ethereum. So we have talked about Bitcoin previously here and there in the last couple episodes, but Bitcoin is a blockchain that is essentially like a bank ledger. So if you listen to the first episode, I talked about how I worked at the bank, which is my golden globe, if you will, because I always talk about my experiences at the bank. But when your computer downloads Bitcoin's blockchain and network, and your computer becomes a node or just a part of the network, and you're able to see every single transaction publicly that has ever occurred on the blockchain, then you would understand what Bitcoin blockchain is. And Bitcoin blockchain was a way for people to do people-to-people transactions, meaning there was no third party, somebody that was being an intermediary or monitoring, verifying, and regulating the transactions that were going on the blockchain. So Bitcoin's purpose was to take out the government, to take out the bank, to take out these third parties like PayPal, like Cash App, that you have to go through in order to transfer your money. Bitcoin was the first ever blockchain and obviously cryptocurrency, but the first ever idea to eliminate the third party, eliminate the middleman, and be able to have a decentralized network where we can buy, sell, and send cryptocurrencies to each other without anybody regulating our money. The whole intent of Bitcoin was to put the power back into people, put independence back into people, let people have more power over their money, where their money's going, their money management, and also just more privacy. Bitcoin gave people more privacy, so the IRS and your taxes, they don't know exactly where your money is going. They're not, taking away your money and taxing all of your money. It was like a chance for freedom for the people. And why a lot of people steer away from that is because they don't understand the software, the technology, how things evolve, how things happen. But really all you need to know is that Bitcoin was a person-to-person payment processing system that allowed people to go off on their own to manage their money, to transact without needing a third party regulating where their money is exactly going. And Bitcoin, like you might be asking, and we talked about consensus mechanisms in the last episode, so definitely make sure to check out that last episode, because Bitcoin's consensus mechanism, meaning how Bitcoin keeps transactions decentralized and keeps verification of transactions and legitimacy of transactions decentralized, is they use proof of work. Proof of work is the consensus mechanism where as soon as you have a ton of transactions and your transactions get formatted in a block and sent out onto the blockchain, people like you and I, regular crypto traders, they're considered crypto miners, but just general people, thousands of people that are on Bitcoin's network that download the software and are on the blockchain with you, have essentially volunteered through their gifts and talents to solve or guesstimate mathematical puzzles to confirm transactions on the blockchain. We touched upon proof of work in the last episode, so definitely check out all the details of it. But proof of work is several different people verifying transactions through mathematical puzzles to solve what your block is looking for. This is through a ton of things that the block header, so if your transactions were in a block and sent out, the block header will give the miner specific information that they need to solve the mathematical formula to find the matching hash to your block that would verify that the work has been done. So Bitcoin uses proof of work. This is going to come in when we talk about what Ethereum uses, but Bitcoin uses proof of work, saying that the work the miners have done has been done honestly. There is proof of work. There is proof of math that has happened, that has helped confirm and verify the transaction without needing, like what the bank does, when you come and give me money and you want to deposit money, I am that verification. As the bank teller, I am the one taking your money with my own eyes and putting it into your account. That is the verification process. And we do that with crypto miners, but there's not just one bank, for example. There's not just one crypto miner or one crypto miner institution or organization that's managing everything. Crypto miners are just people like you and I, people in the general public that are scattered, that are at random, that want to be a crypto miner. And of course you need specific software to do that, and it's very energy intensive, which we're going to talk about in the differences of Bitcoin and Ethereum. But Bitcoin was a way for people-to-people transactions to happen with no third party, and their consensus mechanism is proof of work. So the way that they keep the whole platform decentralized is through that process we just talked about, which is called proof of work. Consensus mechanisms are tips, rules, and regulations, and even what am I trying to say? Like steps and principles that specific blockchains use to help verify and keep the platform decentralized. And Ethereum has that as well. We're going to talk about what they use, and I've touched upon it in the last podcast episode as well. So if you want a refresher on consensus mechanisms, you can check that out. Bitcoin was the first ever blockchain, but following that is Ethereum. Ethereum is very similar to Bitcoin in the sense that you can download the software, go onto the blockchain, your computer will become a node, so it will download all the transactions that have happened, and you can send and transfer money on Ethereum just like you could with Bitcoin. You could buy and sell or send and transfer Bitcoin on Bitcoin's platform. Ether is the native coin of Ethereum, so you can sell and transfer, if you will, buy and transfer Ether on Ethereum's blockchain. Why Ethereum differs from Bitcoin is, picture this. Bitcoin is just a payment processing system, if you will, for this example. Ethereum is more of a computer on your computer. So if you're on your computer and you're on Ethereum's blockchain, Ethereum is trying to be a one-stop destination to all decentralized applications. What that means is Ethereum is like a database or a computer network where when you enter into the computer network, so as if you were to open your computer and turn your computer on, you go into Ethereum and you're on Ethereum's blockchain. You can access DApps, which we're going to talk about, decentralized applications. So that could be games, that could be wealth management tools, that could be different kind of business apps. Like there is a whole world of applications that you can use on Ethereum's network. So it was kind of supposed to be like a hotspot or like, if you will, a decentralized place to have social media apps or wealth management apps or just different applications that would be useful for the general public. So the thing that differs between Ethereum's platform, and let's say you go on and you're using all these decentralized applications on Ethereum's network, the difference is between regular social media platforms is on Ethereum's network, the security of the decentralized applications is dApps, dApps, vocab word, is solely between you and the software engineer. So the person that has created the app, they're in charge of all the security and the management of the platform inside your Ethereum's blockchain, if you will. Ethereum, the blockchain itself, is not regulating or managing any of the security that's going on in the dApps. So Ethereum is just a bigger concept of Bitcoin. Bitcoin was the concept of transactions, people-to-people transactions with no intermediary. Ethereum is taking that and making it much more of a network. Now we can do that, and also we can use decentralized apps where there's not one monitoring company or institution that is managing the whole flow of things. It's multiple people managing the transactions, managing their own personal dApps. It's like a whole community of people that are coming together to create new innovations, like I said, new games, new business ideas, new management tools, anything that's useful without this need of regulation from the government, from banks, etc. So we talked about how Bitcoin uses proof of work. Ethereum uses proof of stake consensus mechanism. So the way that Ethereum is managing and verifying and keeping their platform decentralized is through proof of stake. So I want to give an example that I didn't give previously that I think could help. At the bank, there are such things called CDs, certificate of deposits. And what you can do is you can give the bank a chunk of your money and lock up that money for a certain term of time. And because you are entrusting in the bank and you are risking your money at the bank, and obviously the banks are insured to a certain extent, but let's say you have a certificate of deposit that is a larger amount than what the bank could cover you if you experience fraud or if the bank goes under. The bank can reinsure you, of course, but that's a whole different story for a different day. To my point is that the bank will reward you by giving you interest, by paying you back interest, a small amount of interest that your account will earn over time from the bank, from the market, depending on where the economy is, etc. The same thing sort of goes for proof of stake. Instead of having people mining and solving mathematical formulas to find the matching hash for your block, to verify the transaction, to put the block on the blockchain in sequence, which takes so much computing power, so many issues energy-wise, and I talked about the energy uses of crypto miners a little bit in the last podcast episode, but it's a lot. It's significant. It's using proof of work consensus mechanism in Bitcoin is essentially like keeping the lights on in Switzerland and Poland for an entire year. So crypto mining, you need special software, and proof of work consensus mechanism can take time. It can take time to verify transactions. I believe it could take anywhere between 5 to 10 minutes to verify transactions. So the whole process is slow, it's very energy intensive, and Ethereum's proof of stake is the more money that you have in Ether, for example, Ethereum's native coin, and you're staking it, meaning that you are entrusting in the blockchain to lock up and hold that money and maybe even use that money, you then get rewarded as a validator. So crypto miners using proof of work are at random. Proof of stake is still at random, but it depends on how much money you're staking. Certain coins can only be staked. So there are certain coins that cannot be staked because they don't use that consensus mechanism. I know that Solana and Ethereum or Ether use staking. So, and I talked about, but in my portfolio, I have staked my shares for Ether and Solana. So good to know. And I trade on Coinbase, just in case you're listening and you haven't heard that fact yet either. The more that you invest in Ether and the more you stake, the higher your chances are of being chosen to be a validator. So being chosen to be a validator is at random, but it highly depends on how much you're staking, because you have skin in the blockchain now. You are risking your own financial success into the blockchain by staking it, which proves to the blockchain that you could be a trustworthy validator. So now you're just going into transactions, looking at transactions, validating them, signing off on them, and sending them into the blockchain. So of course, there has to be some credibility within that as well, but that's how Ethereum differs from Bitcoin. They both do person-to-person network transactions if you wanted to do a transaction. Ethereum is a whole new network, a whole new world of possibilities within that, where there's games, there's apps, like I said, just doing a quick recap for everybody. And the main differences between them as well is that Bitcoin uses proof of work. And we've come to find that proof of work may not be feasible in the long run. I had mentioned that what happens when the last crypto or the last Bitcoin is mined, because the whole incentive of proof of work is if you meet or find the matching hash to that block you're trying to verify, the blockchain will reward you with crypto, will reward you with the native coin, which is more Bitcoin. But there's a Bitcoin halving every 4 years. So that incentive gets lower and lower and rarer to achieve. So once the last Bitcoin is mined and all the circulating supply is already out there, what do we do? What is going to be the incentive or the motivation for the blockchain to stay safe and secure? That's why Ethereum moved to proof of stake. Proof of stake is less energy intensive. We need less computing power. Think about all that power to compute, especially in proof of work. It's just not sustainable for the long term. Proof of stake is less energy usage. It's still fair because there's still multiple validators. The only problem that I mentioned too is centralization. So I talked about how the rich can get richer through proof of stake if we are not careful and we don't set certain terms, because the more I put out into the market, the more I might be deemed as trustworthy. And then if I become a validator and I'm validating transactions, then I'm getting rewarded with new native coin, new Ether. So it's like I have to have a certain amount of money to put out there, but then I also get rewarded for having that much money. So it's almost like in proof of stake, the rich get richer. So to combat that in Ethereum, for Ethereum to flow well, we would need set terms on proof of stake validators. You know, you can only be a validator for X amount of time just to avoid things, you know, becoming centralized between certain validators and certain parties in the network. Also, if you're hearing my phone go off right now, I'm so sorry. I don't know who is texting me right now, but I can hear it in my headphones. I don't know if you guys will be able to hear it on the podcast. Okay, another important topic that we need to mention is smart contracts. So you might be asking yourself, Vanessa, how does Ethereum run? How does the technology just know? Smart contracts are contracts that are followed through by AI and technology. So instead of needing a lawyer now to make sure an agreement is followed through upon and the terms are met and they're met at a certain time, Ethereum, and I believe Bitcoin too, I will fact check this and you will see me write something right now if it is true, but I believe Bitcoin also uses smart contracts. I'm sure all blockchains use smart contracts, but smart contracts are technology upholding agreements at a certain time, at a certain date, at a certain amount, if you will. It is just technology holding through things for you now without needing a third party. So in everything in this, when you're thinking about anything to do with blockchain, Bitcoin, crypto, the whole intent is to take out the human and rely more on technology and smart contracts to do things for us. It is simply that the technology is run more on AI. It's run more on coding. It's run more on protocol that's already been preset. So And also, the way that Ethereum is able to continue to run is called gas fees. I don't know if you've heard of gas fees before. This was actually like relatively new for me to learn, like just the concept and the term of gas fees. But there are certain transactional fees that you have to pay in order for Ethereum and Ether to be transferred on the platform. Meaning that when you are attempting a transaction on Ethereum's blockchain, because the transactional rate is so low, and we're going to talk about Ether 2, but I'm talking strictly about Ether 1 here to paint a picture, but to do a transaction on Ethereum's blockchain took a lot of time. There was only like 14 transactions per second on Ethereum 1. So it was a very slow process to get things verified. And because it took so much to make transactions, Ethereum would basically charge you, the Ethereum blockchain would charge you gas fees or transactional fees that would would depend highly on how busy the market was, supply and demand. So if there's a huge influx on Ethereum's blockchain and everybody was on there and so many people were doing transactions, then those gas fees might have been higher. And the gas fees were what were helping Ethereum continue to run. So I want to switch gears now. I want to talk about Ethereum 2. This is a very simple concept, not something that we're going to spend a ton of time on. They realized in Ethereum 1 that in order for Ethereum to grow bigger, having more dApps, more ideas, more innovation, more of a decentral... I just choked on my own spit. God will really humble you. God will really humble you. You could be on the brink of greatness and God will humble you. But anyways, so I don't even remember what I was talking about. Oh, okay. So as Ethereum is trying to grow, they realized that the software that they were using and the way that they were going about things and proof of work and all these old, outdated technology and mechanisms were no longer going to function or just be feasible in the long term. So Ethereum 2.0 came out. Its whole point was easier accessibility, higher scalability, and just faster transactional times and hopefully lower fees. But also I know it gave opportunities to a lot of the people that are on the platform that have created dApps, and I've basically been talking about dApps this entire time, decentralized applications. They are exactly what they are. They are the games, the businesses, the apps that are not run just by one company or one organization. They could be run by several different people. They could be run by a pool of people, but also there's no like deep regulation of them, no third-party regulation of these apps and how they function through Ethereum's blockchain. But if you haven't learned anything in this podcast episode, at least you know that Bitcoin and Ethereum are similar in person-to-person network transfers, in payment, no third-party intermediaries. But Ethereum kind of just wants to be a hotspot of more games, of more apps. It's opening up a world of decentralization in all of our entertainment, in just where we could go with wealth management. There are just so many opportunities in Ethereum, but that's why they needed to upgrade the software so Ethereum can continue to grow and we can continue to create new innovative ideas, new decentralized applications that are going to push us forward in society, maybe more Web3 development, which I'm going to be talking about Web3 soon. I'm very excited. I don't know, I got to think about how I want to direct that, but we have a few episodes before we get there, so hang tight and all this will make perfect sense. But Ethereum is really, really cool. It's the same kind of concept as Bitcoin. It's just going a step further and trying to add entertainment into the mix. I actually wanted to mention one more thing about Ethereum 2.0. It's not to say Ethereum 1 didn't do this as well and Bitcoin doesn't do this as well, but the whole intent of 2.0 was to also better the security of the platform, making sure there's no fraudulent activity, making sure there's no double spending, there's no counterfeit activity going on, and making sure that they're holding their validators accountable. So when a proof of stake is in motion, and this is how we keep the platform decentralized, we keep people verifying things in a decentralized manner, there also had to be an upgrade in slashing. And I talked about slashing and consensus mechanisms, and that's just the platform and the protocol holding people accountable that they might suspect is not being a completely honest validator in the way that they need to be. So there had just been so many upgrades to Ethereum 2.0, and honestly, I gotta roam it. And next episode, we're gonna be talking about some decentralized applications. So if you're like, Vanessa, I need examples of what you're talking about, I'm going to give you ample examples next episode. Next episode is going to be all about decentralized applications. I'm very excited to talk about it. But let's finalize this podcast episode out. I really want to talk about current news, as always, and I think I just wanted to keep it light today, and I think the current news, which would be relevant to this podcast episode, but the current news that I want to talk about is Ethereum, and Ethereum's price, its market cap, its circulating supply, and just give you some facts about it if you're interested in investing in it or you're curious about where it's going to go. Okay, don't mind me, I'm going to just be reading so I make sure I hit all my points here. It's hard being a pro. I'm going to cut that. Okay, Ethereum was created in 2015. One Ether right now today is January 25th, 2025. It's Sunday. So if you're listening to this, just so you can gauge where we're at right now in the market in case you're listening to this like 3 years later. But Ethereum, and let's hope it appreciates in 3 years, it's at $3,500 right now. So one Ether is equal to $3,500. And the market cap is around 402.1 billion, so 402.1 billion, which is just, how do we even wrap our brains around how much it's worth? At all-time high, and back in 2021, was 4,700. So we haven't really seen, it's not far off from its all-time high. If anything, the more awareness that Ethereum is brought to people in the public and people see how great of a tool it can be, I'm hopeful that eventually Ethereum, even now, it's the second greatest blockchain, and Ether is a second greatest cryptocurrency that we've ever seen besides Bitcoin. I'm hopeful that even in time, it's going to continue to stay on Bitcoin. It's going to continue to be the second best because of all the cool features and programming and decentralized opportunities it's giving not only just the general public and transactions, but also businesses and people who create apps and want more freedom, want less regulation, want less rules and protocols, and that's why they're on Ethereum's blockchain. So looking at the stats, it went up about 50% in the past year. So in 2024, we saw Ether appreciate 50% of what it's been. So actually we're again seeing this. We were just talking about Zcash and how well Zcash has been doing again after going through a couple years of a low. And Ethereum was created, like I said, in 2015. So it's been going in waves, but in the last year, we've seen it appreciate 50%, which is a really good sign. And of course, as you're listening and we're growing, we're learning more about the market. We're seeing the value more. And I think that is greatly just on awareness and education and more people being educated about it in a simple way to understand, which is hopefully what I'm doing for you by coming out here every weekend to talk. The circulating supply is 120.5 million. That is a great amount. On Coinbase, the staking rewards are around 2.29 APY, so annual percentage yield. So 2.29, if we're comparing this to the bank, which I'm just saying, like at the bank with CDs and money market accounts, the annual percentage yield, it depends which bank you're at, but this is pretty good. I would say that obviously we should expect and hope the APY for people who are staking and risking their money gets higher. Like anywhere between 4.0 and 5.5 would be amazing, would be great to see as a return for you staking, risking, locking in, and I don't want to say giving your money to the blockchain because you still have ownership of that money, but essentially entrusting the blockchain with your money and in return validating transactions. But 2.29 is not bad for a return annually, but I think, and it depends on if it's getting computed monthly, if it's getting computed daily, but still, hopefully we can see an increase in the APY for staking Ether in the future. And then my last little point here that I thought was really interesting, this is actually new to me, is that Ether can have an unlimited supply. So Bitcoin only has 21 million that can be, that will be in the circulating supply. But Ether can have an unlimited supply. 18 million can be created yearly. So I thought that was really interesting and different from blockchain because they have different consensus mechanisms, but they also have completely different circulating supply. So I'm curious to see how that would function, which I don't want to talk too deeply, but in supply and demand, how continuously having new circulation or like printing new Ether will come in the long term, because we're going to be talking about stable coins and all things that have come from Ethereum that also may impact inflation. But anyways, I just want to say I thought it was really interesting that Ethereum is more unlimited and it's more free, which could be seen as a positive and negative, and then but Bitcoin is, its circulating cap is much less. This is everything I wanted to cover today in this episode. I think I got everything that I wanted to mention out. This one's probably going to be a little bit quicker of an episode, considering that a lot of the things we've already talked about in previous episodes, and it's kind of just like a recap. Plus, Ethereum is very similar to Bitcoin in a lot of ways. And once you get those founding principles down, it's a lot easier to build off them, which is my plan for you. In time, once we start from ground one, we're going to be able to build up and understand these concepts more, like dApps, like smart contracts, learning all the consensus mechanisms. And there's so much more for us to get to, but every Monday at a time, we are going to get there. Thank you guys so much for watching. This episode was one of the easier ones to record. I felt good about it, and I hope you did too. Please, if you want to be a guest on the podcast, email us with the email below. If you have a comment or a question, definitely comment it below on Spotify. We will get it answered for you. And if you are curious about the business idea, check out the business idea with the website that I'm attaching right here. And we are trying to bring justice to FX and crypto traders, people that are interested in both markets that do not want to fall into scams and pyramid schemes like I myself did. The whole intention of this podcast is to bring you the best resources, the best education, talking to the public, and seeing how we can solve these issues and these scammer things that are happening in the specifically the crypto market, but also FX, and see how we can create a community of people that genuinely care about the market and teach effectively, one step at a time. Thank you guys. Have a great week. Again, my name is Vanessa Hurley, and this is Cryptic Humility.